live, we try to remember to record them. As long as you're a member and logged in at smallbusinesswebcast.com, you can go to the events tab and you'll see the recorded webcast under there. Let me get the video going here. Just a moment, and then we'll get going. Okay, now you get to see my ugly mug. Okay, this presentation will be on entity selection, and in particular the tax advantage of whatever type of entity you want to choose for your business. So what we're going to do today is we're going to go through a similar set of examples with each different type of entity. So we're going to make the same assumptions on all of them. Those assumptions are that this business has $100,000 of net income. We have a new person coming in for the live webcast. Eric, have a seat. And so we'll go through and look at all these examples, again making the same assumptions, $100,000 of net business income. We're going to assume that the owner is in a 35% tax bracket but doesn't have any other self-employment or earned income. So here we go with the first slide. We're going to look at a C corporation. So the C corporation has $100,000 of net income. C corporations, unlike other types of entities, pay their own tax. It's a separate entity and it pays its own tax. So the tax rates start out fairly preferential for a C corporation, the first $50,000 being taxed at 15%. So that if you're a C corporation with $100,000 of profit, you're going to pay corporate income tax of $22,250. So that's going to leave the corporation with $77,250 for, well, in the corporate bank account. The owner doesn't yet have that money. It's in the corporate bank account. And you may have heard of the double taxation that you have with C corporations. And that is, in fact, true, because to get that money from the corporate bank account to the owner's bank account, there's tax involved in that. That payment is a dividend. So in this example, we have a dividend of $77,250 to the owner. That dividend is subject to income tax. Now, that income tax used to be, before the Bush tax cuts, that income tax, that dividend was taxed at our ordinary income tax rate, which at the about a decade ago, before the Bush tax cuts, was taxed at a highest rate of 39.6. But now you get that preferential dividend rate of 15%. Keeping in mind that this is the second time this income's been taxed. So the owner's going to pay dividend tax of $11,588 on this. So you started out with $100,000 of earnings after paying all your business expenses except taxes, and you're left with $65,662 to purchase groceries. So in the next example, we're again going to look at a C corporation, but we're going to use a little bit different strategy in getting the earnings to the owner. Instead of paying a dividend, we're going to pay the owner a wage. Now, that we're not able to pay out the entire $100,000 as wage because there is employment taxes involved on the wage, of course. So the most we could pay out to the owner is just under $93,000 because the rest of it has to be paid in employment tax. Let me get my little highlighter going here. So there's the $7,000 of employment tax. So going to the next slide, the owner's got a wage of $93,000. Again, same assumption, they're in a 35% tax bracket, so they're going to pay